Good afternoon, everyone. Bill Ulivari here. I just want to go through a few quick charts to tell you what my opinion and perspective from yesterday's 1,300-point Dow drop. And I'm going to share my screen with you right here. So let's get started. If you have any questions on these charts, don't hesitate to ask. So here we have the first chart is the S&P 500. So what happened in the S&P 500? We were down about 4% yesterday, 4.5%. But the truth is we're just basically unchanged for the month of September. All we basically did was just give back the month's gains and maybe the last 2 weeks of gains in one day. Shocking? Yes. Volatile? Absolutely. But we're still clearly substantially higher than the lows that we put in this June time period, in the March time period. As a matter of fact, we've had a really good decline since the beginning of this year. And again, things seem to be more upward channeling. We're having higher highs, right? We had this high over here that we made recently, higher than the previous high. And the lows are higher. So we're beginning to eke out this upward ascending escalator for the market, I believe. And so I would put very, very little credence in yesterday's decline because the truth is I saw no fundamental changes in the market. This was just a technical sell-off, maybe a momentum sell-off. Like maybe you have to hit the brake in the car real quick because you see all the red lights going up, but traffic is still moving, right? And so I think that's what's happening with the market. Here we have the Russell 2000. I find this chart the most interesting thing. And what we're going to be doing going forward is we're probably going to underweight the S&P 500 and overweight the Russell 2000, the smaller companies. Why? Because what I believe is happening is that what we saw in 2019 is we saw the S&P 500 make a new high and the Russell 2000 not make a new high and begin to decline right around November and December of 2019. And what's happening now, I think, is the opposite. I think the bigger companies like Amazon, Microsoft, Tesla, and the large companies are beginning to pull back because those were the only guys who were open. And the smaller companies, which are beginning to open and come back online, seem to be doing a little bit better. This is very positive for the market, although, again, you can't really tell by listening to the news stories that are going on out there. I just find this interesting divergence between the super big companies and the smaller companies that, frankly, I could name 20 or 30 of these Russell 2000 companies, and you might not even recognize their names. So we're probably, again, going to be shifting from value to growth, which we've done for the last 6 months of the year, and focused on smaller companies rather than the larger ones. Now, this is a chart of the iShares bond portfolio. This consists of a huge basket of bonds all across duration, which means over time. And what we're seeing is our interest rates, our bond markets are as low now as they were, say, back in 2009, 2010, 2008. I think this is actually incredibly positive. It's because some of the excess did come out of the market, and we're beginning to see. So what is the ultimate outcome? The outcome by the Federal Reserve is like, we want to squash inflation. We want to create a recession. The only thing that we're going to do with a recession is make things healthy. Okay, the outcome is what happens in a recession? Higher bond prices, lower interest rates. The mortgage rates have gone from 3% to about 6.5%. I don't think we have to go much higher than that. The danger I see is the Federal Reserve just overplaying their hand, right? And so we have to keep an eye on interest rates here. And I frankly think bond market is an incredibly good bargain down here. I mean, I just think there's some great values here. Okay, this is the federal funds rate. The federal funds rate is the only interest rate the federal government, the Federal Reserve, which is actually not a part of the federal government, but the Federal Reserve only has control of the super short-term rates up front, like 1 month and what they lend bank to bank. Everything else is done by the market. And you can see by looking at this chart here, for the most part, we're still in the sideways action going back to 2007, 2008. Interest rates really haven't gone anywhere in the front end of the range like what we're hearing about. It just makes it seem like Jeremy Powell and the Federal Reserve Chairman is just jacking up interest rates like Paul Volcker did back in the 70s. No, not even close. I mean, yes, we're still below the areas where we were from 2003, not much lower, but really 20 years of sideways action in the market. And the market had a great rally from, the mid 2000s until 2022. So I'm not saying that interest rates don't matter. I'm just saying we've seen higher interest rates in the past, and the market continues to rally higher because why? It's rigged to go up. Here's the Dow Jones Industrial IYY. This is the total market cap index. It's not 30 Dow stocks. It's not 500 S&P stocks. It's not 2,000 stocks. It consists of about 3,500 to 4,000 companies across everything, focused in the United States. And you can see here, clearly above our lows that we made in June, clearly above our highs, our lows that we made in March. And you can see for the most part, we had this red pattern, right? Sell signal, sell signal, sell signal, sell signal. And now we're seeing buy signal, buy signal, buy signal. So until further notice, the verdict to me is that we're eking out a positive trend in the market. The market, I think, is going to potentially rally and make a new high before it makes a new low, just like we saw in this COVID time period. Like we never dreamed in a million years that we would have this kind of rally in the stock market at the end of COVID, yet here we were. Is the same thing going to happen going forward? It's really too soon to tell. All I'm saying is that things are not as bad as they appear, and we're still higher than we were in March, June, July, and August. And again, I think the surprise trade of the year is that equities are going to do well going into the midterm elections. Fixed income and bonds are going to do well. The market's going to do well. And overall, I'm very optimistic about things going forward. Now, again, I'm at odds with what you hear on mainstream media and mainstream news. I'm just saying fundamentally and structurally, the market is as oversold now as it was in March of 2020. So if you're thinking that, boy, why did the market rally after COVID? It was supposed to go down. That's the same thing that's happening here. We're seeing only 8% or 10% or 12% of companies and shares globally, like in the market, are so oversold. It's absolutely ridiculous. Whereas it oversold now as we were, again, during the COVID time period. I find this incredibly exciting. And is the Federal Reserve going to be accommodative? Maybe not so much. But again, I think they're talking a bigger game than they're really going to do. They're letting the big market do their hard work for them. And unless we have a big global event, is it going to be war in Ukraine? Is it going to be some other explosive news? I don't really know. But there's so many convergences of news and events. Again, midterm elections, higher interest rates, energy, gold, silver, all the natural resources are down. Like we're not really experiencing inflation right now. We're almost experiencing deflation. High-grade copper down 40% from its high. We're seeing all the commodities just get crushed, except we're seeing maybe higher food prices at the store. But again, we're not seeing it in the grain market. So I'm just saying there's something going on here that isn't conducive or doesn't align with what you're seeing on mainstream media. And we have to be really careful here because we want to look at data and not an emotion. So if you have any questions about your portfolio, don't hesitate to contact me. I know I had to rip through this fast because, I don't want to bore you with, technical analysis and market analysis, et cetera. But again, I maintain that things are more positive than negative, and the market is always forward looking 6, 8, 9, 10, 12 months. And I think we're just about there. So again, have a great afternoon. If you have any questions, don't hesitate to text me using the messaging system that I sent you this morning and to be able to leave a message if you want a Zoom call. So thank you very much for listening.